Hello, Brokers Are Better Facebook group. We have a special guest today, one of the most highly regarded individuals in our industry, former president and CEO of the Mortgage Bankers Association, former deputy commissioner of HUD, and also leader of many mortgage bankers over the course of his career, both wholesale and retail. David, how are you?
I'm good. Good to be with you, Anthony.
Thank you for taking the time. We greatly appreciate it. Obviously, at a time like this, a lot of people are very concerned. So you're hopefully somebody that can help us with understanding what's going on.
Sure.
So we're going to get started. Obviously, you've been busy. This isn't something that you're sitting on the sideline for. I would say the top topic that most people are talking about here since Friday is the Ginnie Mae announcement through the pass-through assistance program to, essentially provide a facility to servicers of Ginnie Mae backed securities to essentially, borrow default payments or for default payments to bondholders to provide some liquidity. What are your thoughts on how that impacts, the overall equation, MSR values on Ginnie Mae securities, and does that change anything from the current liquidity crunch in that space?
Well, I think it helps it. I would not expect anybody to be looking forward to improved MSR bids on Ginnies anytime soon, for a variety of reasons, and I'll lay them out for you. But without question. So what Ginnie did is they used a protocol, a rule that's in place currently, which is, and they modified it. So the way the rule was established was for institutions technically in default, Ginnie could step in and make advances to bondholders. That's what it was structured for. It was structured for when TBW fails and until the servicing is established and in the new locations, Ginnie could theoretically step in and make those advances. What they modified this to say is you don't have to be technically in default this time, and they can intervene and make advances to the bondholders. Obviously, critically important because, as you know, this forbearance program this time is going to be much different than ones we've seen before, simply because you don't need to prove hardship.
Right.
You can merely attest to the need for forbearance and get access to the program. So, yeah, I mean, it's a big deal. Had that not happened, I mean, ultimately, you got to wonder who would ever bid a Ginnie MSR if the Fed's going to roll out a bunch of programs during an economic crisis and not back it up with the kind of support that's needed like this. There's other things that have to be done, which, our industry, everybody here really well aware of, because all the moves of the Fed and the administration and this legislation will really help calm the economy and bring it back sooner. But at the same time, there's significant risk on the backside to servicers, to mortgage originators, to pipeline hedges and margin calls, you name it. So that's where all the work is focused right now. So again, I think for Ginnie MSRs, what we don't know, and MSRs in general, we don't know ultimately what the broad impact is going to be of this forbearance plan. How many are going to take up forbearance? Is it going to be 5%, 25% higher of borrowers in a servicing portfolio? We have no idea. What will the ultimate reperformance rate be? How many of those, what percentage of those that go into forbearance will come back and reperform the moment we all go back to work and they get their jobs back? For those that don't get their jobs, how big a percentage of that will that be? And what will that mean to default rates? And until a lot of those variables are known, it's going to be really difficult to be able to get confidence for duration buyers, which is what a servicing buyer is, to be able to make a good bid on a Ginnie MSR. And that's why you're seeing such volatility in pricing. It's why you're seeing credit haircuts right now, where 640, 680 is likely the floor. And in high LTV products that the GSEs offer, there are some marginal pulling away for various programs, or tightening on the compensating factor side, meaning FICOs and more. FHA put out uh, their final VOE requirement to get. Now you have to get the final pay stub of the pay period just prior to closing. So we're really tightening the gap between settlement and between re-acknowledgement of probability of continued employment
Yep.
and that they're employed to the settlement. So that slows down perhaps the first payment default rate. But again, all of these are just issues that hit us right now because we're filled with uncertainty.
Yeah, and on that point, I think one of the things that lends into this is just the overall dialogue around this forbearance agreement and what consumers' expectations are.
Yeah.
I think it's been probably one of the biggest takeaways that we've heard from leaders of mortgage lenders that we've interviewed over the last week is just, there's sort of an expectation of whether I can make my payments or not, call and request not to make your payments. And it's I think Willie Newman said it best: is forbearance is not forgiveness. What are your thoughts on how communication's been handled and what loan originators that have worked with these customers can do to hopefully take some corrective communication action?
Well, the first thing is that the communication across the scale of this event has been terrible. And we announced a forbearance plan to the media, members of this administration do, on a Sunday, and there's no actual plan in place. And the Fed steps in and starts buying MBS, not realizing that it's crushing short positions on hedges, and margin calls are coming out of the woodwork, and the dealer community's not willing to yield. I mean, it's just amazing, kind of the downstream effects. But on forbearance itself, that's one of the big problems. And I spoke to a news reporter just about an hour ago who writes for one of the major New York publications. And he's doing a story on just this subject because consumers are calling servicers and saying, hey, I can't make my April payment. What do I do? And the servicers are still talking at this point what's available based on the waterfall of options that spun out of the National Servicing Standards rules that came out of CFPB and more. They're not introducing this new forbearance plan for the most part. So why is that? Because the guidelines aren't clear. What exactly is the program? How do I implement it? And do we have a liquidity facility in place? And all of that has to be established so that servicers can create a set of policies and procedures to roll down to their call centers and their servicing staff in a way to manage this borrower population that may be calling. And unlike the last recession, this isn't going to be spread out over a number of months. This is going to be a single month shock of phone calls that's going to come in. We're going to see it starting tomorrow because that's when payments are due. And we've got a very short period of time between these payments being due to when they're considered delinquent based on grace periods, and ultimately when first payments that same month payment has to be delivered to the MBS holder. So there's a boatload of work going on in Washington right now to figure all of this out. It's been going on all weekend, last couple of weeks since the announcement came out, and in the short run, it's a challenge. If I was if I'm a loan officer, you got to talk to your management and find out what you're supposed to say, because every company is responding to this differently, and really the servicers are ultimately going to be making the calls as to how they're managing this going forward. There is ultimately going to be a plan and policy in place across the industry that's going to demand for everybody to offer a forbearance plan as was provided. But again, there's a lot of work to be done, and it's frantic because all of this happened in a very tight time frame. And Anthony, and everybody else knows who's watching this, this isn't something that we had advance notice on. I mean, 3 weeks ago, I was in LA visiting my daughter.
Yep.
For a fun weekend. I mean, this is crazy.
I texted you that weekend. We were having an event in Orange County.
That's right. And I came home and went, oh my God, maybe I shouldn't have taken that flight. A couple of days later, we're all sitting at home, locking our doors. So this happened all in a matter of weeks. The last recession, we saw the subprime lenders beginning to fail in 2007. The GSEs didn't fail until 2008. And the legislation, all the TARP legislation wasn't passed until late 2008 by the Bush administration and implemented mostly in 2009 during the Obama administration. So That seemed like a tight time frame. That's nothing compared to
Yeah.
what we're dealing with right now. This is a ton of bricks, hit the entire system, hit the entire U.S. economy, and it has nothing to do with economics. It's all based on a virus that hit a very strong economy at a very strong period in our industry's time, and for housing. And by the way, that's all going to come back here shortly as well. But I can talk about that in a moment.
Yeah, I think so. That kind of lends into the next question about margin calls impact on IMBs, and I think so. What you just said is important. January, February, and March were all record origination months for most
Yeah.
of the IMBs out there, and March will be a record funding month for everybody I've talked to, which is not actually good. Unfortunately, it's a very bad time to have a record month
Yeah.
based upon MSR valuations being changed, and also margin calls, unfortunately, due to this frantic Fed buying of mortgage-backed securities, really negatively impacting IMBs. If you could quantify this to loan originators, how massive and how painful has this run on margin calls been?
Well, it varies by institution, and I talked to a ton of folks who are servicers, and some may be listening here on the call. So it varies based on what your position was, what your hedges looked like, and what your liquidity on hand was. The thing I would just emphasize is, well, let's start with the basics. So the Fed needed to step in because there was a massive imbalance in the MBS supply, because a lot of holders of MBS, of mortgage-backed securities, were offloading them to reposition their portfolios based on interest rate moves. And so we had a lot of supply hit the market on top of the high production month that we were all in, the origination side. And it created this massive imbalance. And that's why you guys also saw rates rising up into the near 5 level just before the Fed ultimately stepped in. If they hadn't stepped in, we could have seen some institutional failures and some margin calls, for those that hold MBS. And that was a real challenge, both on the resi side and the multifamily side. Dust bond holders were getting hammered as well. Fed does a good thing. They step in, they cured the patient, but they kept buying. And we saw, 600 basis point price improvement in agency MBS. And that really crushed the market. As you saw yesterday, the Fed got the news. They got the word. They don't have any desire to own agency MBS. In fact, they'd love to get rid of it. They were heading down that path. And we saw prices worsen, yields worsen, which was a good thing.
Which everybody was celebrating yesterday.
Yeah. And I'm looking forward to seeing how the day goes. And I think the Fed now understands how the supply imbalance was impacting the markets broadly. So to that end, I would just say it's a huge deal. And the challenge is for those who have short positions as hedges, and that massive move that created margin calls. And for those who don't do secondary marketing, this isn't a ultimate risk position to any mortgage servicer or mortgage originator who has their pipelines hedged. Ultimately, the rally in rates is going to mean that when they execute the bonds to sell into MBS, they're going to get great marketing gains. I mean, I have talked to an IMB this morning who told me when they hedged, they were at 103, and now they ultimately think they're going to sell at 105. It's just the short version of how many millions they have to put out for these calls. The NBA has been very active. I give them great credit. And guys, I would just tell you, for influential trade groups in Washington, there are a lot of trades that represent our businesses. But for truly influential trades that are big deals in DC, the NBA's been kind of running this solo, and
they've done an amazing job.
Yeah, and they put the letter out. You've seen a lot of articles. The CNBC picked it up, did a couple stories on it. Bloomberg wrote a really good story on it. Everybody in DC is now aware of that issue. There's been pressure to try to get broker dealers to hold off on their calls, on their margin calls. There's also been discussions with Fannie and Freddie to do the same. To date, meaning as of what time it is right now, it's been met mostly with deaf ears, but it doesn't mean that ultimately the pain is going to come, and they'll recognize the pain and they'll make some moves. It's varying across the industry. I've talked to some IMBs who have had to shell out incredible amounts of money on margin calls and aren't certain they're going to get through it. I've talked to a couple others who, fortunately, they feel they have enough cash to pay margin calls and are looking forward to the marketing gains. And the job number one for everybody right now is clean out your pipelines, fund your mortgages as quickly as possible. If you can get ASAP, if you deal directly with the GSEs, get that going. The key is to clean out your pipelines as fast as you can. I'm hopeful that the Fed remains solid in pulling away here and doesn't add to the pile on to the problem that came out of it. But they had the right intention initially, and had they not stepped in, that would have been a whole nother series of problems and a whole bunch of potential failures. So, they're dealing with not just IMBs, they're dealing with the entire financial services industry, which provides liquidity into real estate, commercial and residential. And, we all sit in the asset at different stages along the way, whether you just originate, whether you originate and fund, and you've got your pipelines that you have to hedge, and whether you service, and then ultimately whether you own the MBS. So depending where you sit in the structure, the risk gets transferred around. I think what the administration failed to realize is, they do something that they think is really good, not realizing that the other shoe was going to drop. And, on the backside, there's this group that gets harmed for all the good you're doing to this other group. And that's where you really need an all hands on deck in Washington to make sure you're dealing with this aggressively.
Yeah, that's actually a great point, because I think unintended consequences is probably one of the biggest themes of this last couple of weeks. So, margin calls, the issue is, assuming all the loans fund, things are good. The IMBs get their cash back. The issue right now is rate improvement has been massive. So there are a lot of consumers that have moved their loan or decided to get a better rate from somewhere else. The other issue I think that's out there that's really real is 3.5 million or 3.3 million people lost their job last week. Goldman Sachs came out with a report today saying that they anticipate up to 40 million more in a month. People are going to lose their jobs, and those loans, if they're not funded, will not close. So for IMBs, the margin call issue becomes a realized financial loss if these loans don't fund, and that's a real risk that they have to deal with.
Right. Yeah. I mean, I think this is the uncertainty piece that we're not sure of. And I'll tell you, there was an argument being made to the dealer community that, you don't need to do the margin call, because these are fully collateralized mortgages and they're all going to fund, and there's going to be great gains on the backside. And because of what happened that created this call in the first place, in the dealer community, there's not necessarily the trust level with the originators that their pipelines are going to pull through at the rates that they're expecting. And, depending on who you talk to, I actually think they're going to pull through at a higher rate than most people think, than the dealers community thinks. But it is a problem. And a lot of the broker dealers are owned by banks. And, oftentimes what I've learned in my career is the capital markets regime on Wall Street doesn't understand how the origination business really operates. And there's not a great amount of trust in originators if you're on that side of the scale. So these protections are put in place to be able to execute against them. And unless there's complete faith that these pipelines are going to pull through, it makes it more difficult.
So you mentioned the banks, and I think that kind of lends into a question that I have in reference to, the impact that the False Claims Act has had on banks, and their involvement in the government lending space. Obviously, there's been some court cases that have gone in a different direction. Quicken's case with the False Claims Act. Were banks right to get out of government lending, or is this just simply a black swan event?
Yeah. Well, and to your point, Quicken was smart. Everybody's told them they should settle. They hung in there and fought it through, and they ended up being less harmed than anybody else in this FCA process. Look, I think it would be a disgrace for anybody to say, "I told you so. You shouldn't have been doing FHA loans." If it wasn't for non-banks, we wouldn't have been providing first-time homebuyers the opportunity to get a mortgage. 80% of FHA's first-time home buyers are minority buyers on the purchase side. If everybody had pulled away, we would not have met the need of those borrowers. And you can use this event as a rationale to say something about like FHA and non-banks. FHA supported the recovery of the housing sector, and they're going to do it here in just a few months again when we leap right back close to where we were when we left this off. And I'd love to talk that through. But so, the core fundamental here is these loans aren't bad loans. The non-banks aren't a higher risk proposition here. We're caught in a cash flow crunch. You have to make advances in the short run to the MBS investor. However, most of those loans, I believe, will reperform. Unlike the last recession, these loans were built on far better credit quality. It wasn't built on a subprime market with anybody gets a loan, no doc, negam, 100 LTV,
It's true.
mirror stuff. This was a great credit environment in a shortage of available housing supply in that first-time homebuyer sector. So we're not going to see a massive deflation of home values, particularly in the FHA portfolio. And those were very affordable mortgage payments done at really great credit quality compared to what we saw pre-crisis in an economy that's still fundamentally very strong. This is a timing problem. If the loans do go to default, FHA insurance will reimburse the loss. This is just a matter of the interim of, I know downstream I get recovery, but in the short run, I got to make advances because of this massive forbearance program implemented because of a virus that's really shut down the whole nation. I think in the end of the day, we're going to need and depend on the FHA program to build this housing market back, along with the GSE programs and others. But right now, I believe after this crisis, there's only going to be two games to play, either in Ginnie Mae or in the agency space, and that's going to be it for a while. So, my hats go off to the non-bank community because they're the ones who kept liquidity flowing to home buyers as we've been going through this process, and mortgage brokers, which, as you know, grew dramatically in scale during this period, serving communities across the country that others probably wouldn't serve. That's why you guys are doing what you're doing. And a lot of what you originate goes to non-bank platforms. So, again, in the end of the day, responsible lending is important. We need good counterparty risk measures in place. This is a once-in-a-lifetime phenomenon that none of us have ever been through ever in our lives. And it's going to be a very different kind of recession curve than what we dealt with the last time. It's going to be a quicker recovery than what we've dealt with in the past.
Now, on that note, I would say that crisis management is something that I've gotten a little bit of a front row seat with some of the lenders on, and it's been interesting because, like you said, it's when you talk about companies that have thousands of employees, that all of a sudden they're taking them to work from home and they're maintaining production levels, and then India shuts down, and a lot of lenders rely on offshore underwriting and whatnot. There's been, and then all of this in the midst of margin calls, hectic market conditions, MSR value write-downs, warehouse crunching. In your opinion, what's your view of how the industry's handled, the last couple of weeks?
Yeah. So I think the industry is responding the way I would have expected them to. I've done it. I've been doing several of these kinds of calls per day, whether it's Zoom or Facebook Live or just conference calls with organizations, and the concerns are equally spread across the board. The thing I would just say is everybody needs to realize what we're in. 3 weeks ago, we had no hint that we'd be sitting at home now worrying about margin calls. That just and wondering how our future was going to be. Mark Zandi, the renowned economist from Moody's, sent me a presentation that was done on the 27th, so just a couple days ago. And their forecast is that we're going to see a spike downward in GDP, down close to 19% downward. And for this second quarter 2020, but that we're going to see a spike back up somewhere in the range of 12-ish% the subsequent quarter, immediately following when we all go back to work.
Wow.
And what makes this different, so it won't come back all the way. There is going to be some impact on employment, but looking at the whatever number millions of Americans file unemployment, it's going to be temporary. We're all going to go back to work here in the next 60 days, likely. The vast majority of us will. There'll be some industries that are hurt. Moody's is expecting that the net impact to unemployment will be somewhere in the 5 to 6% range overall once we come out of this. And then they have forecasts for steady GDP going forward. Why did they say this? And particularly for our industry, what does it mean? They say it because we walked into this with an extraordinarily strong economy. Rates are going to remain extremely low when we're out of this, lower than what you had going into it, quite frankly, because the Fed's not going to allow rates to come back up because they've got to make sure the economy fully recovers. And you still have the same demographics. I mean, just take one data point, Anthony. In 2008, when we went into the Great Recession, we had negative household formation on an annualized basis. The owner-occupied household formation was actually negative. We were losing owner-occupied households, and rental household formation was the only positive number. I'd put the slide up if I could, but we can't do it on Facebook Live. But that's a fact, and that happened for several years. Why? Millennials were in their 20s still. That generation's impact to housing hadn't hit yet, and it all came to pass in the decades since, and now we had massive demand for entry-level housing. In fact, some millennials are moving on to home too. And we have a shortage of available inventory in that space. And household formation this past year was 1.6 million new owner-occupied households formed. So we were negative household formation in 08. We were positive household formation by 1.6. And it's a completely different environment. When we walk out of this thing, I'll go back to our offices in a couple months or a month. We're going to walk back into everybody going back to work. The vast majority are going to get back in payroll and getting their paychecks. A lot of folks were furloughed during this period. Department stores furloughed employees and more. And we'll all be heading back to our offices, and we'll be getting back our payroll again. There will be impaired industries. You can guess what those industry classes are going to look like. But even if your neighborhood restaurant had to close because that owner just didn't have enough cash to make it through this being shut down, someone else is going to move in. We've got massive demographic pressure on us right now, creating new households. They're either going to rent or they're going to own. And we're going to walk out of this with mortgages at record lows, still a lack of inventory on the entry-level housing space, which puts a natural floor to where home prices can go. They really can't go down. And we're going to return to the market. So yes, all these wild, crazy numbers of unemployment claims, GDP contractions, and more are going to be short-lived. We're going to see a spike down and a spike back up again. It won't come back to where we are right now, but it's going to come back and be positive when we're out of this, and it'll be likely a quarter-over-quarter event.
Well, I can tell you, Dave, that is the best news. We've been hearing a lot of doom and gloom, so we're very happy to hear this. And this, brokers, if you're listening, I've been telling you now's the time to hire and train. If we listen to Dave, on the other side of this, the rates are going to be low for a while, and the economy is going to be strong. So, start preparing for it. As far as the potential fallout for the industry, I think that's one thing that, there was already calls at the end of 2018 and the beginning of 2019 about liquidity of non-bank lenders and servicers, being as though we've seen in a 2-week period of time, this unbelievable stress on lenders. The big question that, a lot of people are asking is, should there be higher liquidity requirements? Whether it's in the leverage side of things, meaning, the ability to leverage and scale up your servicing or scale up your warehouse lines. What are your thoughts on that?
Well, I think counterparty risk and how you set liquidity and capital requirements is critically important. And, if you recall, once upon a time, you could be approved by a GSE for, I can't remember, it was like a couple $1,000s in capital. This is a different world. I do know that a lot of organizations were working with Ginnie particularly, but the GSEs as well, to come up with a better stress test scenario to allow the investors to stress test an IMB and determine if what their liquidity should be. At the same time, I would also emphasize that I think American policymakers have to realize that the non-bank lender is a critical component to providing housing liquidity to the nation. The fact that the banks pulled out of the FHA program so dramatically for reasonable concerns and real cost paid, but nevertheless pulled out, could have really done terrible harm to people trying to buy a home, particularly minorities and first-time homebuyers, which is that big, massive demographic that is the future of our economy. So we need to have a system that works. So yes, I think there'll be a look at counterparty risk and how to come up with a liquidity formula that will work. And this will be a new event that will be put into the stress testing models along with other recessionary periods as people think about what to prepare for. I also think that the federal government, FHFA as well, need to look at the tools that they are not using to provide liquidity support. Banks can go to the Fed window. Banks can go to the Federal Home Loan Banks, and they can get lines of credit in exchange for collateral pledges. Non-banks don't have access to these support systems, and I wonder for the life of me why that isn't being considered in the policy regime. Banks are backed by FDIC insurance, they have strong capital requirements, and they're typically more diversified, and they're not solely focused on mortgages. But non-banks are too large and too important to the system to not look at collectively as an institution, as an entity that needs to have levers available to it from the federal government when we get exposed to periods like this. And this period is not a period brought on by economic risk.
Yep.
It's not a period brought on by any mistake a mortgage banker made or a mortgage broker made. This period is brought on by a virus. And the government stepped in with a lot of things to throw to consumers and throw to small businesses. But just like they threw lifelines through the SBA program to small businesses, they need to look at IMBs just like they would anybody else who provides mortgage liquidity to the marketplace and make sure that there's abilities to get access to credit lines. So example, I believe strongly the Federal Home Loan Bank System, which is a tool, an arm of the federal government, should have the ability to bring on non-bank originators, non-bank servicers, and allow the opportunity to exchange collateral for lines of credit. These loans are not high risk. These loans are just simply needing to make advances. But most importantly, I would say the federal government needs to recognize if they're going to implement a program, or Congress is going to implement a program which says, okay, now you can just simply attest you can't make your payments for 6 months, and you're free and clear. You can't do that without saying, okay, now who's going to have to make those payments? Oh, these guys are. Do they have enough money to make those advances? These aren't small dollars we're talking about, and you can't do the yin without the yang. I mean, there's big intervention programs by the federal government are what cushions the blow at an event like this. But you've got to look at the sectors of the economy that are ultimately impacted, and this is one that I think needs to happen. That's a long answer. I do, again, relooking at liquidity. Sure, we need to. I mean, we need to make sure our institutions have enough liquidity to get through a severe crisis, and we also need to look through what are the tools that we can also bring to task in those times when that happens.
How does this crisis, I guess short term or not, impact the reality that Fannie Mae, Freddie, there's been this whole push to privatize, but doesn't this kind of show the markets how needed they are?
Well, I would just say, thank God they weren't privatized at this point. I know I'll get attacked from all the pro GSE release guys because they love to attack me for anything I say. But I'm just going to say, I view Fannie and Freddie as critically important utilities to the housing finance sector. And right now, it's the last thing you want to do is tinker with that model. These guys are going to be absolutely critical to coming back. And the more they can be tied to government, federal objectives to bring the economy back, the better off we will all be collectively. Imagine if they were privatized and they weren't in conservatorship where the conservator could force things like forbearance plans. There's not a forbearance plan for jumbo non-agency product, right? Yep. This is for agency. They can do that because the federal government has these folks in conservatorship, just like with the Ginnie Mae programs. I would just say we need to all be really careful. The devil you know versus the devil you don't know. The GSEs got us through the recession, thank God, because they were put into conservatorship and stayed there and kept liquidity flowing. And they're going to get us through this period. My greatest worry is tinkering with them on some fast track because of political concerns or ideological views about the role of government in housing finance right now should be curtailed in respect of the important role that this counter-cyclical lever should play for our housing economy going forward.
I think we saw that very quickly with non-QM. When that got tested, it was brutal and unfortunate, to be honest with you.
Yeah.
So from a perspective of, I think this is a question really for loan originators and whether you're a mortgage broker or work for a retail lender, the question of forbearance is something that's being asked by consumers that are ready to close on loans. And like you said, there's been this expectation that everybody qualifies and governors and political figures are saying, you go ahead and knock yourself out. What is the obligation from a moral perspective from, a loan originator or a lender if they have that conversation with a consumer that's in the, getting ready to close on a mortgage and the consumer right out the gate says, that's what their intention is?
Well, look, first of all, I would say there are a lot of people who have lost their jobs and won't be able to make their mortgage payments, and they deserve, we need to help them. Just like we're helping them with unemployment insurance and more that's been established under legislation. Forbearance is a tool that can help them save their home. The concern I have broadly is just everybody thinking this is a free hall pass on their mortgage payment for two reasons. One, if you can make the payment and you're still working, make your mortgage payment. Do you want that 30 years of interest tacked on 4 or 6 months of payments? The cost has absolutely no rational sense to it if you think of it that way and you don't have to. So there's just a logic financial planning piece that says if you can make your mortgage payment, make your mortgage payment. The second thing I worry about is if borrowers opt in for the forbearance plan, there's this great intent that this won't harm their credit scores. I'm not sure how exactly it will be reported. I don't think anybody is. How will the credit bureaus manage the reporting of a forbearance program? Even if it's not considered a late, but it's flagged in some other way, is that going to impact the availability of future credit to that consumer? I'm not saying it will. I'm not saying it won't. I just didn't say I don't know. And so these are the kind of programs that should be used for people in need. And I think in the end of the day, I'm extremely gratified that Congress stepped in and the administration stepped in and the Federal Reserve stepped in and more the way they have. I think they need to lighten the bumps they created from some of this stuff, which is being worked on right now. But I think this blanket advice to consumers that you can go into forbearance simply by testing that you need it may send the wrong message. I can't be the ethical overseer of anybody on this Facebook Live event, but I think because in the end of the day, you want to recognize the reality that our entire nation has been hit terribly during this time, and there are going to be a lot of people who really need it. So you don't want to scare people or tell them they shouldn't. We need to have our consumers' interest in mind, and we need to have the homeowners' interest in mind. I just think understanding that I don't think it's going to be a free hall pass. I think there's going to be some form of impact if you engage in it, and if you need it, you should take it. But if you don't, I don't think you should go for it because it's not only going to cost you a lot in interest expense over time. It's going to cost you, potentially, in terms of how future creditors evaluate you. And again, the bureaus haven't been clear in terms of how they're going to count or not count a forbearance program. The servicers aren't clear in terms of how they'll report that to the bureaus. And none of that's been established in any policies and procedures, to my knowledge, or at least in terms of most policy procedures from most servicers as we sit here today.
Yeah, I think my message to the broker community and really loan originators in general has been just understanding that you know this is an ecosystem that we're clearly learning. Everything is interconnected. Loan origination, independent mortgage bankers, servicers, everybody is connected, and I do think that loan originators need to take a very big role in communication to their communities and consumers, because at the end of the day, as I've talked to leaders of servicing platforms, default mitigation departments, and they're not going to be able to, nobody that works for them is going to be able to actually educate the consumer. They're going to be so overwhelmed with these calls that nobody's going to be able to sit there and have a 30-minute conversation about all the options. So the first line of defense, in my opinion, is LOs, and obviously take lead from your companies and make sure you follow that policy. But at the same time, this tsunami is coming, and hopefully, we can demonstrate our expertise. So I have 5 questions I've been asking different leaders, and you've actually probably answered a couple of these already, but I'm going to hit you with them in a fast pace. Do you believe we will see home prices decline, and if yes, by how much?
I'm not an economist. And by the way, if anybody tells you they have that answer, they have no idea what they're talking about. I'll tell you what Dr. Zandi told me just a couple of days ago, which is he believes that the vast majority of the entry-level supply housing stock will not decline, or if there's any decline, it'll be marginal, because he believes there's a natural floor simply based on the demographics of demand and the supply that didn't exist, right? We still have the no supply of new homes for that sector that we had a few weeks ago, and
Yep.
we're going to be facing that a few weeks from now. So, and keep in mind, in a few weeks from now, or a couple months from now, whenever it is, when we're all back to work, rates are going to be extraordinarily low, and everybody who's thinking of buying a home a month ago is going to be back thinking about going out and buying that home. So I think we'll be back to multiple bids and the whole 9 yards before you know it. So I don't believe there'll be home price deflation in that sector. In certain areas of the country that depend more on hospitality, and that's where the jobs are, that could be a challenge. And for jumbo loans, for jumbo home sales, high-end home sales, they were already slow in most parts of the country. You weren't seeing the McMansion communities appreciating, and many had longer list times anyway. The stuff that was moving super quick, as you know, was in that sub 750K if you're in a high-end urban community, expensive urban community, sub 500K for other markets across the country. Those were moving overnight. The million plus, the 1.5 million plus and more, those were much slower. Those may suffer some slowdown because the natural market demand is just not there. It's in that first time and move up home buyer.
Absolutely. What is the biggest risk to the mortgage industry at this point, and how do you mitigate it?
Look, the biggest risk is structural to the mortgage companies themselves. It's liquidity. That's all it is. It's liquidity to cover your margin calls on your hedge pipelines. It's liquidity to cover advances on your agency mortgages that require during this forbearance period. That's in my mind the greatest risk. If you can't get through this with enough liquidity to survive a call or to make those advances, that could take down a lot of companies. Beyond that, I think this is going to be a short-lived enough event that, unlike the last recession, which took us years to come out of, right? We hit the peak of the recession in 2008. We were technically out of recession late 2009, but man, we all felt it through 10, 11 until the Fed came in and started really using quantitative easing, and we changed the HARP rules, the HARP refinance program. Suddenly, volume started kicking in. That was a long period. This is going to be like one quarter it's off, next quarter it's on, and so the key is the short term. Getting through the liquidity piece is going to be critical, and the way we do it is going to have a lot to do with how MSR pricing works going forward, how MBS buyers participate in this market going forward, and how quickly things like non-QM and jumbo loans come back the way they at least were a few weeks ago.
What is your number one priority right now?
My number one priority is to support the work that the NBA and others are doing to demand urgency around these liquidity concerns. That's it in DC. My number two priority is speaking to groups like yours. I'm speaking to realtors and mortgage bankers across the country to calm them down off the ledge. This is not 2008. This is not the Great Depression. This is a highly confined, extremely severe impact due to this virus. But this spike response downward is going to be matched by a spike upward over a much tighter time frame than anything any of us have ever experienced in any recession we may have worked through in the past. So we all need to be conveyors of that message, which is this is not the end of the world. This is a period in time. Yeah, we may be careful about group events, and it may be a little while before we jump on a plane and take a trip to Vegas, but we're going to be back at work, and the economy will start moving again. And we had a really strong economy walking right into this thing, which is going to make the leap back far more likely. And that's what I'm hearing from economists. This isn't Dave Stevens making this up or guessing. I don't live on the emotion. When people call me and start screaming about this is the end of the world and what they heard from their father, I'm like, it doesn't do anything for me. We need to deal with
you're like the Tony Robbins for the mortgage banking community right now.
Well, we just need to deal with facts. And by the way, all of you have a job to do, and it's not moan and groan that your now minimum FICO is 680. We're going to be in a tight credit period for a little while here. Just recognize it. Now's the time to go to your realtor partners and your other referral partners and build that relationship and give them better confidence and start looking at ways that you can help them begin to get that message out to the prospective buyers moving forward. They'll remember you for that because all they're hearing is negativity as well. If you're the messenger of, there's a future here, let's get ready for it. I'm going to be your partner doing it. Let's get ready. And there's going to be a big refinance market, Anthony. When we come out of this, people have lost cash. They've lost some value. And if home equity remains relatively where it is, you're going to have a great opportunity to leverage some of the platforms that you use for marketing materials, but take that and help people recognize that if they're eligible, they can get very inexpensive cash out of their home, and that'll allow them to replenish other aspects of their life that were impacted. So,
and think about the opportunity in the stock market right now. If the economy does recover at any point this year, at the stock market right now, how discounted it is, I mean, you would imagine that would return to its highs as well. I mean, that becomes an incredible wealth creation opportunity for consumers. So you actually answered two questions with that one. So I'm gonna skip right to the last one. What is your most optimistic prediction? And this has been very optimistic, but what is your most optimistic prediction?
My predictions, I don't predict. I'm looking at what other predictions are coming to me from people I trust and value from their view. Look, the most optimistic view would be by mid-June, we're all back to work. That the summer puts a lid on Corona and we're already past the hump at that point. So the vast majority of Americans will be back in their jobs. And the economy will begin growing very rapidly from that point forward. So we'll see Q3 potentially is a pretty good quarter and a surprise rebound, not completely back, but back in a big way. For our industry, it'll be back in a much bigger way because you'll walk back into record low interest rates because that's going to be needed to drive the overall economy. So in many ways, being a mortgage banker, it's about the best seat you could be in. But that's my hope. Even if Corona returns in the fall, which Fauci and others are saying could happen or is likely to happen, by that time, hopefully we have better materials. We're better able to deal with the symptoms, and hopefully a virus is not far beyond that. So, really, this is about getting through the next couple months, and assuming we do pass the hump of the spread of the virus, and we start seeing the slope downward or at least leveling, America will go back to work, and you guys will be back to the races. I mean, I think it'll be a little more proactive work from your standpoint to get out to the realtors, get them encouraged, put people back in the game, and get your contact database and look at who's eligible for refinancing at whatever the rates are at that point. But we could be literally ending the year kind of saying, hey, remember how bad it was in, March
and April.
Yeah.
So I got one more. The number of every single lender we've talked to has said the same thing. first time in their entire career, 20 years, I've never seen anything like this. So that's all we've heard for 2 weeks. What has been the biggest learning lesson, or what has been a learning lesson or something that you've picked up here over the last couple of weeks?
Well, these are the times that test winners and separate them from those that aren't. We've been through these before. I've been through terrible recessions. I've been through periods when I was told we could never make a loan to anybody who worked on Wall Street after the dot-com crash. I began this business when rates were, 16% on fixed rate loans, and half my coworkers were leaving the industry because they said it's over. Rates are so high, we're never coming back. This country is screwed. And I walked in, I'm like new and young, and went out, made realtor calls, and became a top loan officer. I think this is a time when you've got to get balance in your own head. You've got to focus on what's achievable. You've got to stop focusing on what you cannot control, and you cannot control this virus other than staying at home. But you can control what your business is going to look like the moment this ends. And if it does end as quickly as some economists are expecting, while it'll be a bumpy recovery, it's still going to be faster than anything you've seen, and you better be damn ready to jump on it. So the surprise for me is the same, I think, for everybody. Who would have ever thought we'd have a national virus, a worldwide virus that would be killing as many people around the globe as it has, that we'd have makeshift hospitals in Central Park, which used to be my jogging path. This is just unbelievable. You couldn't write this in a science fiction book, but in the end of the day, we will get past this, and this is a time for our industry just to be strong, focus on the things we need to try to address: liquidity, hedge calls, margin calls, responsibilities of the government to deal with the steps we're going through right now. There's going to be another piece of legislation, I promise you, that's going to be another step of recovery legislation. We're going to have great input on that. I think everybody needs to be active with their trade associations. I'm a big believer. I'm not a member. I'm not in the MBA. I don't run a mortgage company anymore, but I believe that they are the strongest voice in Washington, D.C. for what has to happen there. We have a lot of great voices, just as AIME is a huge voice for mortgage brokers and has established a great foothold in terms of making brokers feel proud of what they do and create some unity. The voice in DC requires a lot more capital and investment, and I think we all need to be recognizing who's going to fight the battles for us and where those battles are going to be, and line up with them. Because in the end of the day, this is going to be a war we need to get through, and we need to bring our industry back. And guys, all of you are going to be on the front lines of the first points of success for this economic resurgence, because the low rates are going to mean mortgages and refinances. And that's going to be the biggest single attraction to everybody when they first come back in, every consumer who can take advantage of it.
I think that's some really great perspective, and I think that puts everybody that's going to watch this in a good mindset going forward, which is we got to do what we have to do to get through this, and we have to get focused on getting back to work and supporting our communities as we get back to work. So, Dave, we really appreciate your time. This has been wonderful. Our audience left a lot of comments, and it's been very positive. So thank you for your time, and we greatly appreciate everything you do for the industry.
Thanks, Anthony. Good talking to you.
Thank you very much.